My objective with this PowerPoint is simply to talk about startups and bring certain issues to your attention that might be applicable when we're talking about startup companies or startup businesses. Can companies borrow money? Are they allowed to? We're going to look at that. And we're going to look at debt versus equity. What's the difference? And we're going to look at shares, for example, as an example of equity. And then we will quickly look at the Companies Act and the difference between the Companies Act and the Financial Markets Conduct Act. And the question that we have to address is, why do we want to have two acts? What's the difference between the two acts? And then we want to look at why investors need fair information. So our learning objective is still the same. Students will analyze options and generate solutions for raising capital in relation to given business situations. When we talk about raising capital, to raise capital is simply the term used to find funding for your business. Just a quick question as introduction to the capacity of companies. Does a company have the capacity, or is a company allowed to borrow money, or can they only sell shares as a way to get hold of money? If yes, in other words, they've got the capacity to borrow money, according to which act or acts? Companies have the legal capacity and powers of a natural person pursuant to section 16(1)(a) of the Companies Act. In other words, whatever a natural person can do, they can also do it according to section 16(1)(a) of the Companies Act of 1993. In fact, a company can give debt securities as well that are acknowledged by law, and a private person cannot do this. So a company, just keep it in mind, it does not have a brain because it's an artificial legal person. But in law, we however acknowledge a cooperative mind. In other words, whatever the decision of the board of directors are, they basically the cooperative mind. They can make these decisions on behalf of this company. So the moment that you see that word, a cooperative mind, you must have the board of directors in mind. Where a company or an individual seeks to borrow money against the security of real property, such as land, the provisions of the Land Transfer Act of 1952 and the Property Law Act of 2007 plays a role. If money is borrowed against personal property, which acts will play a role, and what will the company or private person have to do? This is just a little bit of a revision. We already did it, but the Personal Property Securities Act of 1999 is handling this, and the interest will have to be registered in the Properties Register. The type of security is called a security interest. I want us to look at the difference between equity and debt, and I've put equity in green because I simply love it, and debt in red because it's directly correlated to risk. So the higher your debt levels, the higher your risk, and the easier your ship can sink or your business can go under. So if you provide equity to a company, you will become a shareholder in that company with certain rights attached to your shares. And lenders do not have those same rights. Shareholding, we also talk about it as stock or shares, represents the company's ownership. When we look at the red, the debt, you have the contractual obligation to pay interests irrespective of whether you're making profits with the lenders. Interest payments is tax deductible for companies. Even now, at this point in time, even if you've got companies specializing in property investment, but the interest deductibility will be denied on a staggered basis that's increasing between 1st of October 2021 and 31 March 2025 for residential property companies. You have to repay your debt at the end of the agreed period. In other words, debt, it's at the end of the period, there will be a final payment, and then you have to pay it all. So the legislation that I've touched on quickly in the previous slide is this new legislation of labor, where if you've invested in property, in other words, residential property, you will not be able to deduct your interest expenses. In other words, it's going to be phased in. So from 31st March 2000 or up till 31st March 2023, you will still be able to deduct 75% of those interest expenses, and then up till 2024, 50% of those expenses. Up till 31 March 2025, from 1 April 2024, only 25% of your expenses, and after 31 March 2025, you will not be able to deduct any of your interest expenses anymore. If we talk about your percentage shareholding in a company, so your percentage shareholding usually determines your percentage claim or the share in the profit. And the profits, when it's paid out, we simply call it dividends. So company ABX issued 1 million shares. If you've got 25,000 shares, how do you calculate your interest in the company? Quickly pause the recording and see if you can do it. And on the next slide, you will find the answer. Then check yourself. Okay, so people, that was a quick and easy one. That was 2.5%. So you simply take your shares divided by the total amount of shares issued, and you multiply it by 100 to get your percentage shareholding. Priced rounds, we already discussed it in our previous class, and it's basically equity investments based on a negotiated valuation of a company or of your company. After agreeing on your company's valuation, an investor gives you money in exchange for preferred stock in your company at the price per share determined by the valuation. If you want to start up a business, you rather want to start it with a lot of shares. And here we've got like penny shares in mind. So because it's a whole process to split your shares in half at a later stage. The initial investment starts with a priced round. Traditionally, the founders and investors agree on an accurate valuation for the company. The investor then gets shares of company stock in exchange for his or her money. The original price of shares all depends on the business valuation. Usually commercial property is valued by looking at their revenue, the income or the profits. If you make 5,000 profit a month, for example, then your total profit will be 60,000 per annum. Businesses in New Zealand, people, and this is what I've got from Google, can sell for plus minus 4 times this amount, but in other countries it's lower. And I spoke to people and they say, no, this 4 times is actually low. It can be much higher. But yeah, there's different ways of determining a business valuation. And most of them, or the majority of them, will not rely on thumbsuck like in this case. A convertible note. We also talk about it as convertible debt, or we can call it a convertible bond. And it's simply a type of a bond that the holder can convert into a specified number of shares of common stock in the issuing company, or cash of equal value. So think about it and you will see that it's a hybrid security with debt and equity-like features. So the beginning of a company, usually the original investors do not sell their shares or do not transfer them. When they issue new stock, it dilutes the existing shareholders' percentage ownership. The reason why people go to convertible notes is simply because the whole original startup process and the negotiation and everything is taking way too long. So directors want to negotiate, for example, a salary and a longer term, but the investors, the attorneys, and your own attorneys need time to negotiate and agree on those valuations. So the convertible notes make room for all those delays. You can get your money way quicker. So based on the question, why convertible notes? The company's stock is the collateral for a convertible note, and the advantage is that you can receive the money earlier than the traditional funding round. So during the funding round, a new round of funding, more data will be available for accurate determination of share prices where everybody is in agreement. In other words, the convertible note will be triggered when the first investors come in or the first priced round. The convertible notes has an interest rate, and usually it's plus minus 5%, almost like what we've seen in the Partnership Law Act, and a discount rate of 10 to 25% on the new investor's valuation with a max valuation cap, in order to compensate the early investing risk taken. If nobody is interested in further investment, the convertible notes can be called up and the company required to pay back its debts. If it cannot, the date for payment is usually extended and more interest can be accumulated to add to the original amount to eventually convert into shares. The issuer of the convertible note can enter into a scheduled repayment over a predetermined and specified period of time. By allowing the company to pay the debt in installments, the company can often afford to pay it back. The Companies Act of 1993 focuses on the form of entity. In other words, so far everything that we've done with regards to entities, we've basically focused on the requirements of having a legal entity and how to keep it legal. In other words, everything in the Act is about the entity and the requirements for that entity. But the Financial Markets Conduct Act of 2013 is activity-based and focuses on the activity of raising capital from the public. Any business that makes offers of financial products, such as shares, is subject to the Financial Markets Conduct Act of 2013. So the main purposes of the Financial Markets Conduct Act of 2013: to promote the confident and informed participation of businesses, investors, and consumers in the financial markets, and to promote and facilitate the development of fair, efficient, and transparent financial markets. Additional purposes. This Act has the following additional purposes: to provide for timely, accurate, and understandable information to be provided to persons, to assist those persons to make decisions relating to financial products or the provision of financial services. To ensure that appropriate governance arrangements apply to financial products and certain financial services that allow for effective monitoring and reduce governance risks. To avoid unnecessary compliance costs, and to promote innovation and flexibility in the financial markets. When it comes to the issue of financial products, we should take the following into consideration. An offer of a financial product for issue requires disclosure to an investor, unless an exclusion applies. In other words, if there's an investor and you've got a certain product that you want to issue, you should give him all the detail so that he can make an informed decision, and it's always true unless there's a specific exclusion in that specific case. The term offer is broader than the technical contract law, meaning, in other words, we've already looked at what an offer is, where you basically make an invitation to somebody, and the moment that they accept it, there's a contract. But over here, if we look at the term offer, it will include invitations for issues or buying financial products. And some of the exclusions that we've been talking about, what are these exclusions? Exclusions are set out in the Financial Market Conduct Act of 2013, Schedule 1. I've given you a link there. You can click on the link and you can look at it, but you will see it includes offers to wholesale investors. In other words, those wholesalers, they are supposed to know everything. You don't have to give them all this nitty-gritty detail. For example, professional investors, persons in a close relationship, close business associates, and relatives. That can be some of the exclusions. What is insider trading? The Financial Markets Conduct Act of 2013 prohibits insider trading. So insider trading is taking advantage of material information that is not available to the market. And the key reason for prohibition is the threat to market integrity, efficiency, and confidence in the financial markets. In other words, it's criminal to get confidential information, inside information, and then go trade on that and make heaps of money. It's criminal all over the world, except for Nancy Pelosi and her husband in the US. An information insider is a person with inside information, and they must not trade in the financial products about which they have the inside information, or disclose inside information unless a certain exception applies, or advise or encourage others to trade in the securities about which they have inside information. I know about the person in South Africa, I'm not going to mention names, but he got inside information from his brother, because his brother is also in a position where he's giving him inside information every now and then, and he's extremely rich based on his investments. But people, it's criminal. Some exceptions and defenses apply, but otherwise, insider trading is a serious criminal offense which attracts heavy penalties. Various civil remedies are also applicable. So it's amazing, because if you Google it, it's not difficult to see how many times similar incidents like this happened between Nancy Pelosi and her husband, but nothing is ever done about that. What is demutualization? It's simply when a corporation, and you know what a corporation is, it's a company that is owned by its members, converts itself into a company owned by shareholders. Before you invest in a company, it's important that you make a decent study and make informed decisions, but where will you get your information from? When I grew up, everybody was always looking at a document that we used to call a prospectus. So a prospectus used to contain extensive information, including financial information, but usually it was lengthy and complex. Then an optional document was introduced, and it was called an investment statement. and it was shorter and more easily understood by the layperson. But both these documents were eventually replaced by the Product Disclosure Statement, PDS, which is aimed at the prudent but non-expert investor.